So over the next 10-15 minutes, we're going to be covering some of the latest findings on the UK economy, occupier market, of course, then moving on to the investment market before we conclude with our panel discussion.
I think the first thing to say is 2024, taking on from what you said, we believe the take-up is going to be around circa 26, 27 million square feet. Which is very positive because it is an increase from where we had the stats last year around 24 million square feet. The important thing I think to say is that it has improved. There's been a number of key deals earlier in the year, which was very positive. If you look at it in line, though, more importantly, with the 10-year average, which is around 27 million square feet, we feel that this year will be very much in line with that, which we believe shows resilience of the logistics market, taking into account we have been in a very sluggish economy, not only from a UK perspective, but a global perspective. So I think it just shows the sustainability of the logistics market going forward, Andrea. As we know, build-to-suits have slowed down quite considerably over the last 2 to 3 years. We actually believe the build-to-suit market will start to pick up again due to a consequence of the lack of availability for occupiers with speculative built schemes for them to choose from.
So we are forecasting an annual rental growth of 4.9% for the UK, with London assets outperforming at around 5.5%. And we believe that this view is quite conservative, so potentially we might see a slightly higher rental growth for 2024. But most importantly, I believe that we should focus on a mid to long-term horizon where we actually be forecasting an annualized average rental growth of around 4% for UK asset to 2024, which means that the I&L sector will outperform any other commercial real estate sector in terms of rental growth, which will make it a key target for investors. Which tells me 2 things really in a simplistic manner. The first one is that the market is highly capitalized, so pricing has held steady in spite of this risk-free rate yield. The second one is, of course, the investors targeting I&L assets are willing to, of course, seek lower return because of what's going on elsewhere in the real estate universe, with, of course, some of the assets underperforming based on the way people use real estate nowadays since the pandemic.
David, kind of kicking off from your point of view, I've said about the mood improving a little bit, but casting your mind back to this event, this presentation a year or so ago, what stands out to you in terms of how the market has moved on?
Yeah, thanks, Jess. So I think just wanted to touch on a few kind of positives. Andrea and Len have already kind of discussed them, but I just wanted to kind of summarise. So I think from a political perspective, we're in a more stable environment. We know where we're going for the next 5 years with the Labour government, who obviously won with a significant majority. The UK economy is, GDP growth is flat, but inflation is under control, importantly, and on target. The interest rate environment is now trending in a positive direction, and we've obviously had our first rate cut in the UK with more expected in the reasonably short term. So I think how does that impact real estate and what's changed over the last 12 months? Well, from our perspective, there's definitely an improving sentiment out there. The industrial logistics and the living sectors remain at the top of the majority of investors' kind of requirement lists, based on the fundamentals of the sector. The majority of capital over the last 12 months has been in that kind of value add space. But we are starting to see that change, and more capital is being raised for core plus strategies. And we're starting to see within the market a number of those kind of core plus capital pots starting to back developers and taking on leasing risk, but in return for core quality stock at a slight discount. So I think that's really important to kind of a message to pass across.
Great, thank you. And Jason, you know, as a fellow investor, are you kind of boots on the ground? Is that tallying with what you're hearing across Len and Andrea's presentation in terms of improving sentiment and also those points around, you know, pricing of assets and what people are willing to go for?
Yeah, absolutely. I think we generally think that sentiment is improving. We're cautiously optimistic in the occupational space. I actually think personally that the investment market has a stronger level of sentiment currently than the occupier markets. And just building on what Andrea and Len and David have said, we've definitely got a point of, you know, real momentum in the market at the moment. And I think you look back to the start of the year, certainly in the capital markets, there was quite a wide sort of bid spread ask between vendors and sellers. And, you know, some processes were elongated. They were taking, you know, a while. Valuations were possibly too high from some sellers, so you know pricing wasn't aligned. I would say that certainly in the sort of spheres we're in at the primer end, the core end of the market, that you know we're at a point of equilibrium between buyers and sellers. So we now have people on the same page and transactions are happening. There's certainly been a building momentum and a building weight of an increasing weight, sorry, of institutional capital that's come back into the market over the summer. There's a handful of processes that we can point to now where there's been, you know, pretty aggressive bidding. There's been a couple of assets in London, a couple in the Midlands, and you know one recently up at Trafford Park in the Northwest where there's been over 10 bidders, and you know that's been, you know, very positive for the market where the pricing is almost turbocharged.
You know, thinking about what occupiers want, thinking about the direction of the market, previous years, the success of locations and asset pricing, it has been all about location, all about the core locations. But now we're obviously looking at the future of a vast amount of stock and what to do with it. Is there much hope for those secondary and tertiary locations in terms of trading or even potential redevelopment? David?
The majority just will not compromise on that. So they'd rather buy a poor quality building in the right location, something to do to it, as opposed to going off location into an unestablished or a new micro location. And I think that's something that we need to refocus on in terms of what the stock that we're looking to kind of deliver for some of our clients. Generally speaking, there are still some buildings which were kind of delivered in 2021, 2022 in secondary and tertiary locations which are still vacant, and that just gives me a bit of nervousness around this conversation, because and it just reinforces the fact that, you know, it's all about location.
Buildings are all built with a 50-60 year you know lifespan, so effectively we're getting to the second, third, you know, fourth generation leases, and the buildings can be churned again. So it's quite an easy decision on a lot of that kit, where the buildings are, you know, they're still functionally, you know, they're not obsolete, they're still functionally fine. There's one example in the Midlands that I can point to where we spent I think £20 to £25 a foot on a retrofit capex budget on a 350,000 square foot unit. So you know, a decently sized investment into the building, and we increased the EPT from an E107 to an A17.
You know, you get the perennial discussion about, do you get a premium rent for an ESG building? And for ages it's been a question mark. It may still be a question mark, but I think there are certain buildings or certain occupiers who will not take your product unless it's ticking all those boxes.
Clearly in the UK, prime yields have been pretty stable for the last 12-18 months, but hopefully trending in a more positive direction going forward. But we definitely need more transactional evidence to support the yield conversation, because at the moment there are very limited comparables to kind of actually hang your hat on for specifically for developers and also people thinking about their exit yields in the future. You know, how can you kind of actually really be confident that you're going to achieve that in the future when there's very little evidence today to support that? So I think once we start to see a bit more churn in the transactional markets at the core and corpus and that will give investors, developers much more confidence around their future business plans and where they're going to exit. And I think once that starts to come through in a better fashion, we'll be in a stronger place as a market as well.
Charlie, you know, your role as a landlord and, you know, some occupier relationships you've had for a very long time. What's your kind of view on, landlord-tenant relationships, how that partnership is going to change and shift, and what impact that can make on long-term strategies?
Yeah, we're like Jason. We're long-term holders of our product and the product and our assets that we buy and the product that we developed. And long-term relationships with our clients is extremely important. And when we're engaging with new clients from a development perspective, I think that's a very positive conversation that we always have. You're engaging with us as a team from day one, looking at your piece of dirt, we'll build it for you, and they know that we will be there to run with them during their occupation of the building. And I think that's a big positive. I think we've got well over 100 tenants within the portfolio, and asset managers and property managers regularly to see our tenants and build up that trust and the relationships with them. And that's, you get to understand what their businesses are about, what they're looking to achieve within a specific building, and what their aspirations are for their business going forward. And since we acquired our development portfolio, our development platform back in 2019, we've got a land portfolio which can accommodate up to 42 million square feet if the planner said yes to everything. And having that arrow in the quiver, which we didn't have prior to buying the development team, is a great benefit, because we can look to accommodate clients changing supply chain portfolio aspirations, either within our spec delivery offering or within our sites that are either there with consent and infrastructured up, which I call in a credible delivery state, or if people are looking further afield, 4 or 5 years down the line, we can accommodate their longer term aspirations potentially on sites that we've yet to bring through the planning process. Well, I'll try and end on a positive. If the new government does deliver its 1.5 million homes over the next 5 years, each home has a baked-in requirement for about 69 square feet of logistics. On an annualised basis, that means another over 20 million square feet of logistics space that's needed over the term of this Parliament on an annual basis. So another potentially very heavy tailwind or strong tailwind for our sector.